I mean, this group, we've been talking mostly about that kind of line between venture and growth capital, because these groups do both and we're quite familiar with it. I'd be interested in understanding a little bit better, and maybe some of the people in the audience would too, that line between growth and buyout or bigger PE, you know, and kind of refining the line of where, like, your firm has had a lot of experience.
Well, I think someone mentioned, you know, where does the capital go? Okay, so actually we're talking with, you know, one very large mega buyout shop about a growth equity investment where they're going to give, you know, 30, 40, $50 million of capital to a company, not to buy out. Not a dollar will go to retire shareholders. It'll all be put into expanding the business. So to me, that's a growth deal. You know, I think a buyout deal, you know, I think actually it's fairly clear cut. If a group is putting in capital where they're going to buy, you know, majority control, so it's a control-oriented investment. If the capital is going to buy out prior shareholders, those are the features that I think distinguish a buyout. I also think historically buyout has been, you know, Six Sigma approaches to operating discipline of a company. So they want to really improve the operations of a company. In healthcare, that hasn't always led to making money because you got reimbursement risk. And as reimbursement comes down, you know, a 15% EBITDA margin business can quickly become a 7% EBITDA margin business unless you're doing something to grow your top line. So, you know, I think that, and Dan, your shop could probably speak to that.
Yeah, I mean, I think I would actually, not to confuse the matter even more, but I think where there's probably something in between what I would call growth buyout. So, you know, buyout in my mind is big, you know, 25 plus EBITDA, 50 plus million EBITDA businesses that are growing 5%, that you can lever, you know, leverage the big thing in my mind. You can lever 5 or 6 times, use great cash flow to pay that down, and you can make 2.5 times on a business growing 5%. That's different to me than buyouts or growth buyouts that we look at now, which is 15% plus organic growth, plus some acquisitions, plus de novo builds that you can, I would consider that organic as well, where it's, you know, maybe 5 to 10 million of EBITDA growing at that rate. And that's more, I still consider that growth equity. I mean, you know, it's not the traditional, you know, $20 million to, you know, juice your or accelerate your sales and marketing spend and get people out there. But it still is, in my mind, continuing growth, and if not accelerating growth, it's just in more, it's in either majority fashion or in, you know, through acquisition.
Yeah, it's interesting, and in all these discussions, it's funny because, you know, whether you're a large buyout firm or a small boutique venture fund, your definition of growth would be different. I think the common theme in everything we talk about, which I think is interesting, and I think it's an ongoing trend, is just there's so many of the deals that we're now seeing and funding that, you know, 5, certainly 10 years ago would have been publicly funded. I think that's a major shift. It's funny because one of the questions we always get from LPs is about how much competition there is for the various deals we're all talking about. And the answer is yes, there's a lot of competition. But the basket of opportunities is continually growing because these kind of lower middle and middle market healthcare businesses, particularly the founder-owned, entrepreneurially owned ones that would have never considered taking in an investment partner, you know, a certain number of years ago, if they do want to do any type of transaction involving partial liquidity, acquisition capital, they don't have that public market opportunity. And the size of transactions, I mean, you know, when I think back to, you know, starting in the 90s, the idea of 100 million of revenue, 20 in EBITDA, family-owned business, taking money from the likes of us, it wouldn't have happened. Whereas today, that's commonplace, and the size of those deals is going up. So as public market investors are only wanting to make commitments to healthcare companies in particular that have much greater market caps and are much further down the maturity spectrum, the opportunity set for all of us, and again, whether it's a big buyout firm or otherwise, is just that much more increasing. We actually think, you know, you referenced TA and Summit a little while ago. We actually think there's some great opportunities, you know, in those founder-owned entrepreneurial businesses. There's a niche there, particularly well-suited for the way we're thinking about growth equity. And the reason I say that is I remember, you know, 15 years ago, you know, CS First Boston and others, you get these private placement memorandums. They're looking to raise, you know, $20 million for, you know, a 25% stake. You don't get those anymore because the economics to those that would work with those businesses are no longer there. It's not a lost leader to then take them public. There's a lot of middle market healthcare private equity funds that have grown up, but are really telling their LPs they're only going to do control transactions.
Yes.
Most venture funds have a very negative knee-jerk reaction to putting in money into a company to then have the founder put that in their checking account. So I think if you are comfortable working with these kind of 30 million in revenue plus private companies and doing some type of a structured minority investment for some combination of liquidity and growth capital, it's more work because you have to go find those businesses and develop those relationships. But I think there's a fertile ground there, and I think that is one, in addition to our interest in working with existing venture-funded and PE-backed businesses for expansion capital, that's a part of the market, particularly on the technology-enabled services side, that we're trying to really focus in on.
Yeah, I would just say one thing on Summit TA. I think it's important to. I think another key theme is what's some people think about, and I think if I just said to my friends in banking or whatever, how do you think about growth equity? They'd say, oh, that's $20 million to $50 million investing. You know, venture is 5 to 15 million, Series A, B. Buyout is 70 million or whatever, but above. I think that's the dollar amount kind of functions as that. To your point about TA and Summit and all these guys who started as growth equity and they still call themselves growth equity. Right. With billion-dollar fund sizes, right? Yeah. I worked at TA for a little while. You can't write anything less than 75 million to be meaningful, right? So growth equity is a lot tougher. Your ecosystem's a lot smaller, and so to your point, there's a gap in those businesses that are between 20 and 100 million in revenue.
There's this category of companies who 5, 7, 3 years ago, whenever we and our colleagues invested in them, we had a thesis that the company would be sold when they got to X. Medtech companies, maybe that was in the midst of their PMA approval trial, and biopharma companies, that was if we show good data in phase 2 or phase 3, somebody's going to pick them up. And as we're all acutely aware of, the bar for acquisitions from the strategics, particularly in the categories of pharmaceuticals and medical devices, has moved along. And these investment syndicates have had to take their investments further along and layer on top of that the constraints in the amount of capital that's available. You now have a category of companies that are good technology, good companies that have to be taken to that next step of development, which, as we've all talked about, is launching commercially. And now we have the ability.
There's definitely a higher bar or a risk aversion a bit from the strategics. And the capital market requirements to go public is much larger. But what's interesting is the debt players now coming into the growth equity space and trying to fill that niche and offering these flexible deals where they'll offer a high growth company $40-60 million line or capital infusion where they can take one portion of it but have the option of taking it even.
Where have they done 40 to 60? I've seen up to 20 in venture debt. I've never seen 40 to 60.
No, they'll do 40 to 60 on. I'm thinking more of businesses with 10 million of EBITDA.
Oh, okay. That's different.
Or cash flow.
Oh, absolutely.
Yeah, or rocket ship growth companies that the visibility is there.
Have they taken it on cash flow negative businesses at that
I know
degree?
One example. But I'm saying
Impressive.
that it is a...
Who's that lender?
The venture debt folks have started to recognize this emerging growth equity opportunity too, because there's all the mid-market lenders out there that typically lend to 10 plus in EBITDA businesses, particularly on the services side. I think that one of the issues we run into is something we talk about that 18 million revenue business we're referencing. Sometimes when you see those business plans where it's going from 18 to 25 to 32 to 46, now that's good growth per se, and certainly as a percent basis. But if you really think about it, and you run that model. If that's all equity financed, whatever you chose to do, it's actually not that great in terms of generating returns. And so I think that as there is this public market gap for these kinds of companies, I think the venture debt lenders like Oxford, Hercules, and others have started now to come in to try and focus, much like a lot of venture funds have migrated to doing more growth equity and trying to fill a role there. And I think where that's helpful too is, as an equity sponsor, 5 or 10 years ago when fund sizes were bigger and you were thinking about your next fund, if there was an opportunity to put a $30 million round yourself into one of these opportunities, you may just choose to do that. I think both because capital is more scarce and you're trying to enhance and manage returns better, there probably is more inclination now to say, you know what, if I could put in 18 and borrow 12 in venture debt, it's less dilutive if it is a founder-oriented situation, so that may sell well with the entrepreneur I'm trying to do business with. So I think trying to be a little bit more aggressive about managing multiples and IRRs through the use of those kinds of debt facilities, albeit a little more work, may become more common.